Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be taking a look at Walmart stock. They posted earnings this morning, and so I want to talk about that a little bit in this video and show you a little bit of valuation analysis and why I think it's important. As always, this isn't individual investing advice. This is just how I analyze stocks. If you have a request you'd like me to take a look at, just put it down in the comments section and I'll get it on the whiteboard behind me. This is my personal pick for the day. It didn't come from the whiteboard. Just because sometimes I notice things that just seem totally kind of disconnected from reality a little bit. And I think Walmart is a great example of the current dividend stock bubble that we're in right now. For transparency purposes, I've been bearish on Walmart since 2019. I think since my first bearish article, which was somewhere in here, it's up maybe like 35% or something. It is up less than the S&P 500, but it's definitely up. Some of that had to do with just the COVID boom that we had. Walmart was one of those stores that was able to deliver during COVID. And also they've been able to raise their prices along with inflation. So they've been able to kind of keep up better. And I think it made a bigger difference because they didn't really have any growth going into COVID, which you can see in the fast graph here. So let's shorten this to 2015 so we get a little closer to look. So when I first was writing about and bearish on Walmart, from 2015 to 2019, they really had basically negative earnings growth. So it wasn't until COVID, and then even this year we had tax cuts. So they were basically in decline on an earnings basis as a business. But the stock price rose to a 25 PE on a no-growth business. So to me, that's an easy call because you're paying a lot for earnings and you're not getting any growth in return. If you want to wait 25 years to earn your money back that you invest in Walmart from their earnings, then it would have been okay. But to me, that's not a good investment. So we had these bumps from COVID, and as soon as that was over, we saw earnings come down. I think earnings came in at they came in higher than this at 665 for 2020. Well, their fiscal 2024, but for everybody else, 2023. So that's better than the 3% growth. But the narrative on the television when I watch Bloomberg is like, well, they posted strong earnings. Well, they posted 5% growth. I mean, that's okay. I mean, inflation's 4% this year, so we're close to it. So they got 1% on an earnings per share basis this year. They didn't buy back as much stock as they had in the past, so there was only a small bit of that could be attributed to buybacks. But we're talking about 1% real growth, okay? That's not strong. And the stock trades, and it's up again, which isn't even going to be in this. The stock trades at the 26. It might be at a 27 PE now, with 1% real earnings growth. Now, if you don't use real, that's fine. I mean, one of the reasons you own stocks is because they can raise their prices. The businesses can raise their prices. So if we want to go with the 5%, that's okay. But that's only in this little period that we've had right here. When you go back to 2015, and then they were also buying back stock during this time leading into COVID. So it's even worse than it appears here. And the stock went completely in the opposite direction than it should have if people were being rational. So, and what that works out to is, if you do the math on it, they're growing less than 1% once you take into account buybacks, and they have a little bit of debt. When you take that in, add that into the stock price, you're looking at about a 3% compounded return over the next 10 years when you do the math on that. That's the same rate as inflation. If you watch my inflation video, you'll see. So what we really have here with Walmart is a business that is stable but not growing, okay? Not growing in real terms. And so you get a benefit of that compared to a bond in that you can get these earnings bumps because they can raise their prices and earnings will go up. Even if it's just to account for inflation, at least you're getting to account for inflation, right? You're getting the 3%. The thing is, and they also announced a 9% dividend increase. I went and read on some of the news articles, some of the comments, and people were really excited about this 9% dividend increase, but they only have a 1.34% dividend. Now, for me, for a no-growth business, as a rule of thumb, you should be looking at close to an 8% dividend before it would become attractive to me, because you're only going to get whatever that yield is plus inflation. So that's where it would be attractive to me. For other investors who maybe aren't as stingy as I am, a 6% yield would probably be the minimum for a no-growth business. So, and these guys are at 1.3%. Okay, so that's how far off. Like a factor of 4 or 5 is how far off the valuation is from where a rational investor would, what they would pay for this stock, right? So you have to ask yourself, well, why is this? I usually don't just assume that the market is wrong until I see a pattern. So I see dozens of stocks like this, and Walmart is just an extremely clear example where retirees are buying this for the dividend and the perceived safety of the brand. Okay, so if you think of your average 60 to 85-year-old who's buying individual stocks right now, they all know Walmart. That they feel like even during a recession, Walmart would do well because people would trade down and go to Walmart. So there's that element of safety to the stock. They have a long history of paying a dividend, even though it hasn't really gone anywhere, because the management knows that earnings aren't going anywhere, so they don't want to raise it to where they'd ever have to cut it. So people are just willing to pay a lot of money, and that section of society is this section of part of the age cohort that has pretty much all the money, right? All the investable money, because everybody else is paying student loans and mortgages and putting their kids in school and doing all those kind of things. And it's really not until you get old where your money's had time to compound over time as well. So there's a lot of older people. They have a lot of money. They want things that they feel comfortable with. So any of these outward-facing brands with a long history that just have this safe narrative attached to them are attracting people, are attracting these type of investors. And I see it all over the place, but Walmart's a great example. So if we just went back so boomers started retiring around 2010 at the beginning of the first boomers. And then they basically, they're about 2/3 of the way through this process now, because it was sped up a lot there were a lot more extra early retirees during COVID. So the halfway point between kind of now and I want to say we go until maybe like 2030 is about 2020. But you really started to see when interest rates and bond rates were low that before more and more boomers retired, Walmart traded. Look how fast earnings growth was. Let me just show you the disconnect we have here. I mean, it's stark. Let's go to here so we can see. Okay, earnings growth during this time period. Let's go back. Let's back it up 1 year to the peak here before things started. They flattened out a little bit, but they hadn't totally gone down. Okay, so even after that flattening out, earnings growth was growing 9% on average. Or no, from point to point. through the Great Recession, 9% earnings growth. And you want to know what PE Walmart was trading at during that time? Let's get far away from the Great Recession and just go right here. About a 15 PE. So 9% earnings growth. And that was it was the same during all this whole time period, a 15 PE with 9% earnings growth, and 0% interest rates. Okay. Now they're growing. If you use just the fast graphs method, I mean, mine is more conservative because I take more things into account. But if we just back it up to where we left off at 2015, even using the fast graphs, earnings growth is 2.37%, okay? From point to point over this 10-year time period. Instead of 9%, and instead of a 15 PE ratio, we have a 26 or a 27 PE ratio, all right? So pretty much double. And that doesn't even include that growth is 1/3 of what it was. And it doesn't include interest rates were 0% back then, and a 10-year is over 4% now. And short-term interest rates are close to 5%. So there's no rational explanation for this, okay? Other than more boomers retired during this time period, and they were attracted to these type of dividend paying, well-known brand, safe feeling businesses. And especially when interest rates were low, as more and more of them retired, they were gravitating toward these types of stocks. Things that they knew, things that, felt safe. And it's just really interesting to me when the news comes out and there's 5% growth, and that's strong. That beat the expectations, which expectation was for 3% growth. And we have 4% inflation during this past year. And that's strong, right? I kind of pound the table on this a little bit because I just see it on a lot of different stocks. And especially when the narrative in the media is leading people down the wrong path. I see this with Apple too, but at least they're a technology company. They'll say Apple had strong earnings when revenues have been, other than the COVID years, right here, they've been flat for a long time. So just be careful, do the math. I always focus on the numbers and then think about some of the assumptions that are going into it. Think about where it could go wrong. But when the numbers get this disconnected, eventually it will, you'll get bad returns, just like the Nifty 50 back in the 1960s. A lot of those businesses really were the best businesses over the next 30 years. But investors didn't make very much money, and they lost money for a decade or more because they were just so overvalued. And this is one of those stocks that, as the numbers are here right now, is overvalued. If they do grow 8% or 9%, that would improve things a little bit. We can look and see, actually, because I can just plug 9% in. That's still more expensive than the rest of the stock market, and it's a 4% return. It's not even like cash. That's not even what you can get on cash. Now, you might not be able to get that on cash for the whole 10 years, although you actually can get it with the 10-year treasury. So this is super expensive, super overvalued. Better off to hold short-term treasuries than to buy Walmart stock at these levels. Okay, if you found this useful, thought-provoking, if it just makes you even just think a little bit, hit the subscribe button. I have hundreds of, we're at over 100 videos now, I think, of individual stock analysis where you can learn how to actually just do this math that I show here. I go through it in detail, usually in every single video, or almost every video. And I have a full service if you ever decide you want to join there, if you think this makes sense and the results are looking pretty good. and those links will be down in the description. And then if you found fast graphs here useful, I have a 25% off discount link down in the description for that as well. All right, thanks for watching. I'll see everybody later. If anything else jumps out at me as a little crazy, I'll make another video. Bye.